Hello and welcome to the Global Dialogue. I'm Shereen Bhan. We are living in a VUCA world. CEOs around the world have been used to the idea of dealing with volatility, complexity, ambiguity, and uncertainty. But what we've seen happen in the last few weeks is perhaps VUCA on steroids. To help make sense of the global reset, where India finds itself, and more importantly, how we should position ourselves as this global reordering takes place. Joining me now is a global managing partner of McKinsey, Bob Sternfels, and the managing partner for McKinsey in India, Rajat Dhawan. Bob, Rajat, great to have you here joining us on the Global Dialogue. Let me start by asking you just that, Bob. When you talk to clients today, what are they telling you? Is there a sense of panic? Is there a sense of fear? Is there a chilling effect that nobody wants to do anything at this point in time?
Well, it's great to see you again, Shereen, and thanks for having me on. And yeah, I would start with, it's clearly the context. There's a lot going on in the world today. But if you take the lens of at least what I'm hearing from CEOs around the world, which I think was the departure point of your question, I think it's very different than a year ago. So if we backed up a year ago, most were saying, and you were clear on this, that, hey, 2024 is the year of elections. And there were more elections around the world than I think in any year in recorded history. And so as a result, many CEOs were saying, let me wait and see how things play out. Let's see what happens with this particular election. And so if I can defer some decisions, I will. And I'll play for time. Well, you fast forward to the beginning of 2025, and folks are saying the elections have happened. Yeah. The world's no less volatile, and might even be more volatile than it was a year ago. But I can't afford to wait. I actually have to make decisions. And I find that's one big departure point from even 12 months ago, that despite this volatility, there's a real desire to still need to move forward.
You know, when you talk about moving forward, and as I pointed out, CEOs are used to dealing with uncertainty and ambiguity. But in a situation like this, where on an hourly or even on a minute-by-minute basis, you don't know whether a tariff is going to stick or not stick, whether there's going to be a further hike or there's going to be a rollback, as we've seen in the last 2 weeks. How do you make decisions in this environment? And are people now essentially saying, let the dust settle before we make big calls, whether it's CapEx or expansion? I mean, that's the kind of feedback that I'm trying to understand how that's playing out.
I think you're really getting to the root of the issue here. And how do you make decisions given so many different impulses, and the fact that these inbound new bits of data can happen multiple times a day? I think all of us look at our phones many times a day to see what's the latest, particularly coming from my country. But you know, what I hear from CEOs underneath this are a few things that I think are useful in these times. And on the one hand, making long-term decisions on things that may not have long-term assurance is not a recipe for success. And so many CEOs are coming back to a couple principles that at least I hear. One is the notion of resilience. How resilient is my company to future shocks going forward? Because these may not be the last. And I'm hearing more and more, I may need just to plan for a world that is fundamentally volatile, as opposed to hoping for a return to some kind of normality. And so how resilient is my company? And the resilience notion is not just defensive, but how do I have enough capital, enough talent to make a few bold bets while I protect myself from shocks? So I hear resilience as one. The second thing is this notion of timeframes. Will the decisions that I'm making be durable over the time frame of that investment decision? So if it's moving a supply chain, if it's developing a natural resource, if it's making an R&D decision, these are often decade-plus decisions with decade-plus payback cycles. And so what I often find is, how do I marry the return profile with the volatility profile to say, is this something that is robust no matter what? So take a practical example on this. Many are asking around the world, how much of my supply chain should I have in the US, right? Given tariffs. Well, if you back up, we had done some work in the pre-tariff era that said supply chains aren't resilient enough, that COVID and the Russia invasion of Ukraine showed that we actually had fragile supply chains. And there was a logic for moving part of your supply chain closer to the source of demand. The US is the largest source of demand, irrespective of tariffs. And so several CEOs are coming back to that foundational logic to say, would I make this decision even without tariffs? What portion of this is robust long-term, based either on resilience logic, long-term demand logic? That's a practical example of this time frame piece. And maybe the third thing I'm hearing, if it's resilience, time frames synchronized with the investment decisions, the third is this notion of where are no regret moves just to speed up? And in particular, one of the topics that's around that is the implementation of new technologies to change my business. No matter what happens in the world, I am going to have to implement technology faster to change my business. That's a no regret move. And so I'm often asked the question, Bob, what are the no regret moves that I can be implementing irrespective of these external stimulus that's going on?
We don't have the ability to pay your fee today, but we're going to ask you, Bob, nevertheless, to give us some of those no regret moves in just a second. But let me get Rajat to comment on the feedback that you're getting from your Indian clients today, because the way that we look at the narrative that's shaping up, the feeling is that India is going to be a beneficiary of this tariff move, or even as Bob put it, even outside of the tariffs, India has been positioning itself as a manufacturing hub. Case in point, the smartphone success story. Build on that. What are you hearing now as far as the near short-term implications of this global reset and the decisions that you believe CEOs are likely to take on the back of it?
Yeah, great. So as I talk to the CEOs and the boardrooms here in India, I think you called it. I think the general posture is let the dust settle. Because I think this news flow, which is a flip and flop going on over the last couple of weeks and will continue, there's a lot of short-term noise. But equally, I think to Bob's point, there are some no-regret opportunities coming out, right? I mean, electronics value chain you already cited out. It's starting to play out, and I think continued investment there is going to work. But I step back a little bit to say, hey, from in this moment, what is the real long-term signal emerging for the Indian economy, right? And firstly, I'd say that we are at a good place already, not just because of the global dynamics and where we are positioned, but also a lot of hard work over the last 5, 10, 15 years, where the Indian economy has now gotten to and what is the potentiality. I think we're at a good place. I think the real long-term signal emerging in this moment is that we need a new playbook to take it to full potential growth. And by full potential, I mean 8.5% real GDP growth consistently for 20, 25 years. And that's possible. That's possible. I think there are 3 elements of this new playbook. And I think the sooner we embrace it and start to execute it, the better. I think the first one is we need a new playbook for investment formation. And I'll come back and talk about it. But at the second level, I would say we need a new playbook to raise our competitiveness, and innovation goes with it, especially in manufacturing. And again, I'm happy to talk about the elements there. And then third, I would say, is really a new playbook needed to dovetail skilling with job creation in a significant way, because that starts to get us closer to where we would get our demographic dividend to play out. Let me talk about the first one at least, and then pause and then see where you want to take the conversation. On the investment formation, at the end of it, there are 3 elements to it. I think there's a government spending around infrastructure.
Which has been doing the heavy lifting.
Which is doing the heavy lifting. If I take the IPL cricketing analogy, Bob, the IPL tournament is going on. That's the batsman that's making the runs in the last 5 or 10 years. We've got to about 11 lakh crore, what's about 120, 130 billion. I think there the new playbook now is go away from what I call linear infrastructure development, linear and point infrastructure of roads, railroads, ports, to what I call economically dense infrastructure. Think of cities, new cities, 20, 30 new cities. It could be brownfield next to already existing city hubs. It could be around economic clusters. But imagine, our analytics tell us that if you really go for even a brownfield city, leave alone a greenfield new city, over a 20-year period, it could be anywhere between 80 to 120 billion dollars of cumulative GDP that accrues. Jobs happen, and the government, the federal government along with the state governments, if there was a way to partner in with a very efficient vehicle, right? I remember the DMRC phenomenon of 20 odd years ago, and then Delhi happened, and then so many other cities came forward with the metro. I think something similar, could be a great way of what I call economically dense infrastructure creation, and government could be the catalyst. Let's talk about corporate investment, private sector investment. Stagnated about 12-13% of the GDP.
Yeah.
There you see, there is an underlying, improvement or strengthening that has happened which has not been noticed, which is that, look, erstwhile it was all debt finance. Most of the investments were debt financed. Over the last 4 or 5 years, with capital values appreciating, equity markets going up, particularly in mid and small caps, a lot of that risk has shifted onto equity.
Equities.
People have, companies have infused capital, they have deleveraged, and now the interest rate cycle is also turning, right? With the RBI adopting a pro-growth stance. So I feel like the timing is right. We're waiting for the demand signals. But the mix of capital as we go forward in the new playbook will be a lot more equity-oriented, a lot more risk capital-oriented. Because, I mean, promoters and CEOs don't want to lose their sleep. I think they're sleeping better because of all the deleveraged balance sheets.
Oh, without a doubt.
Goes back to the resilience bit that Bob talked about. And then the final bit on investment is really the MNC capital. You see, our domestic savings rate around 30% is not going to go up substantially, right? Because, I mean, as income demographics grow, households want to consume rather than save and so on and so forth. I think we need foreign capital. We need FDI capital, MNC capital. And there, I think the only big shift we want is not so much ease of doing business. A lot has been done. And frankly, no boardroom or CEO globally decides based on whether I have to fill 20 forms or 70 forms, right? They decide, is there an upside for value creation in the country? And if there is a downside, am I protected with the right legal framework, the right settlements? So I would shift from ease of doing business to a new playbook called facilitative foreign capital, inviting and facilitating a fair play for the MNC capital to come in.
Equal level playing field for foreign companies in India. Is there a feedback coming in that they feel that the playing field is not equal?
Look, I mean, empirical evidence is in front of us, vertical by vertical, industries by industries. You see that actually it's a share of the domestic private sector as well as government PSU sector. I mean, the share is actually growing, and the MNCs by and large are getting squeezed in the country. And I think, to the extent there could be I wouldn't call it a fair or level playing field, but it's just the assurance around taxation, around legal matters and predictability.
Exactly. I mean, stuff that's been on the table.
And we need that FDI capital. Because, I mean, that's going to be the difference between us.
Without a doubt. We do need that FDI capital. Plenty there to unpack. But, Bob, let's continue with the India conversation in the context of what's happening with the global reset at this point in time. To Rajat's point on competitiveness, to the point on your point on supply chain diversification and supply chain resilience, the role that you believe India is likely to play, when we look at what happened between 2017 and 2024, and this is the data that McKinsey has put together, the beneficiary of the supply chain diversification out of China was to the ASEAN region and more to countries like Vietnam. So India has seen an incremental uptick, but perhaps not to the potential that it would like to see. How do you believe that's likely to change?
I might maybe one comment just on the past bit. I think the MNCs, just to close on that topic, it's not only for capital, but it's also for technology transfer.
And innovation. Yeah.
Right? And we should look at both aspects as catalysts to growth for India. And my sense is it's less a level playing field, but more examples of MNCs that have thrived in India because it's a viral game. And so the more examples of folks who have actually been successful will be in the boardrooms around the world saying it's possible. And what does that look like? And then you will know the better preconditions of that. But if you come back to the future growth potential for India and you start with manufacturing, India is nowhere near its full potential around this. And you highlighted, I think, a success story. I think you have to hand it to Vietnam in how quickly they moved. But on a relative basis, Vietnam's small. And Vietnam now is facing all of the secondary issues labor shortages, supply chain issues, overconcentration, et cetera, that India won't face for a while. And I think this is really the moment to now move from a catalytic change that has started in India about this notion of a strong manufacturing base to now kinking the curve and really starting to drive acceleration at scale. And so I am very excited, and I'm excited because you root this logic not in tariffs, right? You root this logic in the fundamental notion of resilient supply chains. And therefore, from an investment decision, whether you're an Indian company or an MNC, looking at Indian manufacturing and Indian supply chain, you can get excited about making that long-term investment.
And you believe it makes business sense, irrespective of whether the tariff differential varies and India stands to benefit at this point in time or not?
Could be, just building on that, I think there could be granularity to that approach as well, right? And granularity at two levels. I think firstly, where are the end markets? I mean, if you are really exporting, manufacturing in India for the world, we cannot be super competitive in everywhere, right? I mean, you have to pick your. It's like going and winning Olympic gold. You pick your categories, as opposed to saying in all the 120 sporting categories, I'll win a gold. You say, here are my 10 or 12. I think that analogy plays out even in manufacturing. We actually have identified 10 to 12 value chains. In fact, further segmented into saying we are already competitive globally. Let foreign capital come in here. Let it create jobs. Let it create investment, and let's scale. Pharma formulations is one of those examples. Auto components, specialty chemicals. I would call them as the scale industry. Just build scale from 20 odd billion of exports towards 80, 100 billion.
Right? And by the way, to your point, we shouldn't be solely focused on the U.S. in this.
Sure.
When you think about global growth and India's position to this, you get very excited about other markets as well. ASEAN, the GCC in the Gulf, but also looking at competitiveness into Europe. And so I think that that's the other lens to this. Sometimes we get obsessed with the US, and it is the largest economy in the world. But this manufacturing in India for the world also can take advantage of differential growth rates in other markets around the world aside from the US.
Don't be so US focused necessarily. But on the point that you were making about the US, Bob, and as companies are looking at the possibility of moving supply chains back to the US, where do you believe we're likely to see that happen the fastest? There are, of course, restrictions that the Trump administration is imposing, saying that for particular industries, you will have to operate out of the U.S., for instance. But where are you seeing the most momentum at this point in time in terms of actually moving supply chains to the U.S.?
Well, I think first I come back to the logic on this needs to endure past a tariff regime. And so where you start to see movement, you see logic around semiconductors.
Strategic.
And semiconductors has multiple components to it. One is a very fragile supply chain that has a pinch point dependency, particularly around Taiwan. You layer in a national security incentive around this, and a large job growth multiplier that puts incentive not just at a federal government or tariff level, but the mayor of Phoenix provides massive incentive to TSMC because of the job growth potential that this drives for the Phoenix area and Phoenix, Arizona. So you see semiconductors as one of the supply chains that is really moving, and I think moving irrespective of tariffs. The other are ones that are energy dependent. And one of the things I think we also forget in this discussion is that the U.S. has a really strong competitive advantage in energy, in particular in natural gas.
Right.
So natural gas provides a really unique opportunity as you think about the revitalization of the petrochemicals industry, and also around LNG exports. Now, these things are going to be robust irrespective of a tariff regime. And so you start to see large capital moving in, taking advantage of low-cost natural gas. That is something that is a long-term trend that would be robust. Those would be two verticals that I would pick that are already in the acceleration phase, independent of the tariff regime.
Pharmaceuticals, and I ask you this in the context of decisions that Indian companies, the larger suppliers of generics to the US, will perhaps have to look at. I mean, the Trump administration has made it very clear that there will be tariffs on pharmaceuticals. They've also asked for supply chains to move to the US. You know, do you see that being a possibility? I mean, today when we talk to Indian CEOs in pharma companies, they believe that that's far more complex, you know, to move, and not just from a cost point of view.
Yeah, maybe my quick perspective on that is, you know, to his point, it has to last beyond, it has to endure beyond the tariff flip and flop and so on, right? Tariff regime, and therefore the cost imperative is a pretty important one. So I think the disruptor there could be AI coming into manufacturing, humanoid AI, for example. The waves are moving, right? The Gen AI waves are fast moving. There was a text and prose creation wave. There's been an agentic AI wave now, and I think humanoid AI, you know, where human-like robots with cognition could be on the shop floor to solve shop floor issues and so on. That starts to change the game, because then the labor cost is thrown out of the equation. If that kind of disruption comes in, frankly, the imperative will build. So, but I would base that development on much more the cost competitiveness and technology enablement.
Well, and life science in particular is probably the trickiest one, because there's, as you know well, there's many factors at play in this. The U.S. drives the disproportionate share of the global profit pool for pharma, and it drives this through its pricing structure. The pricing structure is a complicated system of government reimbursement, et cetera. And so independent of the tariffs, there's also a view on what is going to happen to the health system going forward, which is one of the largest sources of federal spending, you know, in the U.S. And how global pharma companies think about their footprint first depends on what do you think about the global profit pools in the United States. That has an aspect of reimbursement, pricing regimes, et cetera. And so you need to take a view first on that. I think then you take a view on, well, what impact does then tariffs and also tax incentive have in terms of where I place my manufacturing? And you are seeing several announcements. Novartis was one of the most recent of moving some of the manufacturing to the US. And I think you will see that. The part, though, that I get excited about is I wonder if the question for India, and you two will know more about this, is really a manufacturing question game as it relates to pharma, or an innovation game. And this builds a bit on, Rajat, where you are going, but you know, what I see as one of the greatest opportunities for India is that India moves from an era of phenomenal high-quality, low-cost production to a source of R&D and innovation. And that you move up the value chain, that this becomes core R&D as we start to do more and more of the applied technology here in India. Then the value is in the IP, not in the manufacturing, which then becomes less a geographic question and one that India can retain most of the value from. And so I wonder if that's an exciting, maybe corollary to this question.
No, absolutely. And that coupled with the fact that we have such large market opportunity domestically. I mean, ultimately 60-65% of the GDP is domestic consumption, and that's likely to continue to power it. And if you fast forward 20-30 years of GDP cumulatively, right, you know that all the essential goods and so on are about 25-30% of the consumption. You know, housing is up there with 15, mobility, cars, and all sorts of mobility is another 15%, and so on and so forth. Then you start to get to some desirables around travel, hospitality, 10%. So you have trillions of dollars of that spending coming. And to his point, is there a way to accelerate the consumption curves on the back of innovation? Because that suddenly opens up larger and larger markets. With larger markets, you can also get globally competitive faster. So there is a virtuous cycle there that we could get to.
No, there certainly is a virtuous cycle, but what we're seeing happen on the innovation and R&D side, disproportionately housed in the global capability centers that many companies like yours have set up in India, as opposed to Indian companies spending on R&D, which continues to be quite low at this point in time. But Bob, you know, to the no regret moves that you were talking about, and I think this is something that Indian IT is going to be looking at very closely, because at the start of the year, the expectation was on the back of deregulation in the US, this was going to be an explosive year as far as demand for IT services was concerned. What's the expectation? Do you believe that there's going to be a slowdown on discretionary spends on technology, or do you believe that this is going to be one of those things that will continue irrespective?
You know, Shereen, I think it's a great question, and if you do back up, there was a lot of enthusiasm amongst business leaders all over the world in November, December on the deregulation front. And you know, that theme also shouldn't be lost. Sometimes I know that the tariff theme tends to dominate, but there is a lot of move in the US in particular around deregulation. And I think that one will now start to gain momentum and is one to watch. So I'd keep your eye on the deregulation. But the other excitement was coming agnostic of government intervention, which was the whole Gen AI revolution and how do you move into now value creation. Now, the interesting part was we did a survey of 500 of our clients worldwide and asked a very simple question. How many of you could identify P&L improvements from Gen AI in 2024? And the number was less than 14%. So what I actually hear right now is we're at an inflection point, and I'll simplify things, but if I ask a CEO, non-tech CEO, many will say, Bob, you know, do I listen to my CIO or my CFO?
Yeah.
Right? So my CFO is saying, I don't see the value yet. My CIO is saying, yeah, but we're right at the time. Don't lose faith right now. And what we're finding is that there's real learnings in those 14% of enterprises that are figuring this out. That there's massive disruption potential to reinvent the business. And when I look at 2025 and 2026, I think you'll see that number really start to rise. And here's where I think Indian technology providers can play a really unique role in changing the fundamental thesis from amazing talent that is resident here to amazing technology that is delivered. And amazing technology that is delivered not just for efficiency grounds, but for transformative grounds. And how to actually be, I think India has a moment to be a leader in Gen AI, first in services, but then let me put a marker in, back to our manufacturing topic.
Yes.
The next big application is going to be in robotics. And so is Indian manufacturing not just efficient, but more effective because it leapfrogs, say, Vietnam, by already adopting robotics from day one to get to a position that no one else can touch.
You know, let's talk about what this also means in terms of not just FDI, but M&A. And you said that this could perhaps be an opportunity for people to consider bold bets as well. Do you believe that we're likely to see a risk-off on M&A as well as FDI, or do you believe that some strategic deals may perhaps go through, or are the deals likely to be more existential in nature?
You know, again, take a more medium-term view, not just the next couple quarters, but the next couple of years. I think you could make a case that there's a logic for more M&A activity, and more M&A activity in multiple vectors. So one vector is cross-border, and this idea that we didn't value diversification across geographies as much as we should have, and it's a way to deal with this inherent volatility. And we are seeing a very high increase in requests on cross-border M&A scans. So I think cross-border. The second is cross-product. And you know, for years we always grew up with the stick to your knitting, focus, et cetera. And I think one of the things we've seen, if the world's going to be fundamentally more volatile, we may have undervalued diversification, particularly if you can provide some synergy across the collection of assets. And so we're seeing an increase in requests around step-out opportunities for particular companies. And then the third is with a technology thesis. How do I deepen my technology quotient, particularly if I'm a non-tech company, where I know that I'm not going to be able to outsource this. I'm going to need more tech, whether I'm a manufacturer, whether I'm a pharmaceutical company, et cetera. And so how do I see step-outs in acquisitions that have more of a tech component in this? And I think you're going to see accelerated activity across all three of those vectors, at least if we take a multi-year horizon on this.
And if you look at the Indian corporates, I think Indian corporates incumbents are pretty good at domestic M&As to go take positions in new verticals, adjacencies, tuck-ins.
Or consolidation within sectors,
a particular sector, absolutely, you know, an unorganized sector, just roll it up. I think we're still learning the art, if you ask me, despite some acquisitions that have happened cross-border, large acquisitions. to gain access into newer markets and to gain access of technologies or capabilities. I think that art is still being learned, if you will, by India Inc. And I think opportunities will come up, but now there is a supply side question of really going and doing it right so that it, again, starts to create the confidence to go and acquire.
Well, you know, we're pretty much at the end of our time, so let me ask you, Bob, it's 100 years for McKinsey in 2026, 30 plus years here for McKinsey in India. You know, as you look at the McKinsey playbook today, and I'll ask you this in the context of the many learnings as well as the setbacks that you've had to deal with. You've settled with the Department of Justice for over $600 million in the case that you had with Purdue Pharma. I know you've decided to prioritize distinctiveness over growth. In an environment that's as challenging as the one that we're in today, does it become harder for you to say no to clients, you know, even though you want to believe in being distinctive versus driving for growth?
Well, I think it's a great question, Shereen. And I'd start with India. And we're incredibly proud that 1/3 of our total history is with India. And the reason I come so many times a year is I do believe, we've talked a lot about the volatility in the world. Oddly, I actually think a lot of this volatility could be great for India. And I think there is this moment, and you know, I've been on record before of India's century, and I'm not backing off of that. I really do think this is the moment for India to lean forward with all of this volatility and figure out how do we accelerate coming out of it. And so I start with that notion. You know, you made mention that our broader history, so we invented this profession, and yes, we'll turn 100 in 2026, and we're using it as a moment to both look back and look forward. Look back, how did we get here, and what did our predecessors do to build the firm that we've all inherited? Because we have stewardship to then move it forward. And then looking forward, what does this mean for how do we continue to reinvent ourselves? And you've hit on one of the key themes for us, and folks may not know, but you know, we're a private partnership that looks at the future around this notion of distinctiveness. And you and I spoke about this previously, but the idea that you're not going to hear McKinsey talk about its own growth, obsessed with how we're doing, because we're obsessed with how our clients are doing. And this idea that we want every bit of work that we do with our clients anywhere in the world to pass this marker of distinctiveness. And you know, you mentioned, is that harder or not in times like this? Look, they can't be values or objectives if you're not willing to pay something for them, right? And this is where you're tested on core principles of values. And one of our values is that distinctiveness will help drive long-term health and growth. But it does come at this ability to say no to things. But saying no in that instance is good for us over the long term because it separates the kind of work that McKinsey should work on versus not. We think we should work on the toughest problems, not all problems. There are other folks who can solve some of that solution space. We want to focus on the stuff over here. And it comes with fortitude, but we're pretty confident that that times like this will actually be good for us on this dimension.
So you've spent about, what, $1 billion in risk and compliance related spends. Do you believe that you need to do more as you look ahead?
Absolutely, because it comes down to trust. And ultimately, we work with our clients on their most sensitive topics. Things that are intimate, things where the CEO is vulnerable. We need to give that CEO and their whole team the absolute assurance that we're doing everything we can to keep them safe. And that becomes more and more complicated around the world when you operate in 70 countries across a whole range of industries. So I don't think we're ever going to be there. I want us to stay on the edge of defining the professional standards for our profession. And that means we're going to continue to reinvest in risk and compliance, just like we're doing in R&D, just like we're doing in upskilling. It's now a category, because it's a category, I don't mean this not for the regulators, it's a category for our clients that says, this is why you should put your trust in us, because we're going to set the standard for professionalism for our industry.
So you said that, to operate in India, and I remember both of you saying this, you require an immense amount of stamina and resilience. But as we look at 2025, and, Larry Fink believes we're already in a recession, Ray Dalio believes we're going to see something far more profound than a recession, and there's all kinds of opinion on what this could mean. How do you... What is the 2025 forecast? Let's just keep it near term, because we don't know what's going to develop in the next few days.
Yeah, I mean, like for India, I would say absolutely. Like there's some commentators who are talking about, is this a 1991 moment, particularly precipitated by tariffs? By no means. I think we're far from that. I think we've had a mild correction. My sense is we're just about to turn the corner back on growth. So we're very buoyant. We're very sanguine about it. And frankly, I mean, look, as we get to 100 globally and 35 in India, we're super, super committed to make sure that we bring about sustainable and inclusive growth for the country in the next 20 years. It's our time. And accelerate the digital revolution, the technological revolution in the country, because we are absolutely sure that will provide us the escape velocity as a country.
Global?
My thought is it depends on if we think this question is exogenous or endogenous. If you think it's exogenous, that it's going to happen, and I'm not an actor. As a private sector CEO, I'm not an actor. I think we're in for tough times, right? If you think this is endogenous and that I play a role in this, and back to some of the conversation we've been having, there are many actions that I can take despite this volatility. Leaning forward and taking those actions will end up driving economic growth, and I think things will be better than some of the most pessimistic forecasts have. If it leads to periods of stagnation and we move into a wait mode, I think those could actually come to pass. What we're setting out to do is to try and build as much conviction with CEOs around the world that this is an endogenous question and not an exogenous question, to try and avoid that particular outcome. So I think it's in our hands.
It's in our hands. We'll have to wait to see how this plays out. But Bob and Rajat, many, many thanks for joining us here to take us through what the world view looks like, and more importantly, the outlook for India. Appreciate your time, and look forward to seeing more of you again. And Bob, seeing you back in India when the McKinsey Global Board visits, which is going to be in a couple of months from now. But thanks very much for joining us.
Thanks for having me.
Thank you.
Well, with that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye, and many thanks for watching.